Welcome to The Explainer. So, if you're a retail investor, meaning you're out there putting your hard-earned money into the market to build a future, you've probably wondered what's actually happening behind closed doors, right? Today, we're going to set the stage for a real investigation into the professional standards of the finance industry. We're looking directly at the CFA Institute's Code of Ethics to figure out exactly how the rules these investment pros are supposed to follow directly impact your wealth. Let's dive in. To really understand why these rules even exist, we gotta start with a punch. Think back to Enron or the global financial crisis. These aren't just dry historical events, They were catastrophic market failures. Everyday investors got burned, badly, because corporate trust just entirely collapsed. These massive financial scandals showed the whole world exactly how unethical conduct can destroy companies, completely wipe out retail investors, and literally cripple entire economies. Which brings us to the absolute most important question for you, the investor. When the market breaks, who protects your money? Are the analysts, the portfolio managers, and those investment advisors managing your life savings actually playing by rules designed to protect you? Or are they playing a completely different game entirely?
Chapter 1: The Foundation of Trust.
Look, the core mechanism of the financial market doesn't just run on numbers or fancy algorithms or stock tickers. It runs on trust. Period. Investors absolutely have to trust the research professionals and the advisors handling their money. Without that foundational trust, the whole system just grinds to a halt. According to the CFA ethics framework, when analysts and portfolio managers abandon their moral foundation, you get this super predictable and dangerous domino effect. First, investor confidence just tanks. And when people don't trust the system, the markets become inherently unstable. That instability breeds an environment where fraud skyrockets. And ultimately, it's the companies, everyday investors like us, and the broader economies that are left holding the bag.
Chapter 2: The Fiduciary Duty.
Now, this is a term you've probably heard thrown around, but it is the absolute gold standard of financial care. It's the benchmark we should expect from literally anyone handling retail investments. Fiduciary duty means that client interests come before personal interests, no exceptions. Under the CFA Institute Code of Ethics, a professional has to place the integrity of the profession and the welfare of their clients above everything else. Personal gain should never, ever override this fiduciary duty. It's just non-negotiable. Let's look at two totally different realities for a mutual fund manager. On one hand, you've got a manager acting as a true fiduciary. They are choosing investments strictly because they're the absolute best fit for the client's portfolio. Simple, right? But on the other hand, you have a manager who is just looking out for their own wallet. They're picking investments simply because they generate the highest personal commission for themselves. One is protecting your money, the other is essentially using your money to enrich themselves. Chapter 3: Ethics versus the law. So we often kind of assume that if an investment advisor is acting legally, they must be acting ethically, right? Actually, no. There is a massive, stark contrast between these two standards. Think about legal requirements. The law is really just a baseline. It's the absolute minimum mandatory compliance required to, well, not go to jail. It's the floor. But then we have moral principles and ethics. Ethics demand a much, much higher standard of behavior. Ethical standards can, and honestly often do, go way beyond what the law mandates, just to make sure the investor is actually protected. Which leads to this absolutely crucial point in the CFA framework. If local law conflicts with CFA standards, follow the stricter rule. This right here shows how true investment professionals are taught to navigate legal gray areas. They don't just hunt around for legal loopholes. They are literally bound to whichever rule offers the highest level of protection to you, the client.
Chapter 4: Case Study: Insider Trading.
Okay, let's walk through a bit of a mini thriller to see exactly how a lack of these ethical standards causes direct harm. We'll look at the anatomy of an unfair trade, straight out of the curriculum's examples. Step 1. Imagine an analyst at a company like Infosys learns privately that their quarterly profits are going to be way higher than the market expects. This is what we call material, non-public information. Step 2. Before that public announcement even drops, the analyst privately buys Infosys shares for their own personal account. Step 3. The public ends up trading without this crucial knowledge. Guys, this is a blatant violation of the integrity of capital markets, simply because that inside info was weaponized for personal gain. And to anchor this hypothetical scenario to reality, we only need to look at the Rajaratnam case. This was huge. It became one of the most famous insider trading scandals globally, and it serves as a massive real-world parallel to our Infosys example. It showed everyone exactly what happens when fair dealing is just completely thrown out the window.
But who really gets hurt here? It is so important to understand that these are absolutely not victimless crimes. Retail investors are the ones left lacking equal information. When an unfair advantage is created for insiders, the everyday investor is basically forced to play a rigged game. And because of that, overall market confidence is destroyed and the core integrity of our capital markets is deeply, deeply violated.
Chapter 5. Case Study, Hidden Conflicts. Now we're going to investigate another incredibly common danger that might actually be lurking in the financial advice you receive: a conflict of interest. This is a situation where a professional's personal interest might actually bias their professional judgment. When your advisor has a conflict of interest, the recommendations they're giving you might not actually be about what's best for your portfolio at all. Let's break down the actual mechanics of this kind of hidden agenda. Imagine a portfolio manager who personally owns a massive quantity of a specific stock. That's step 1. Then, in step 2, they turn around and recommend those exact same shares to you and their other clients, completely failing to mention that they own them. In step 3, as all these clients buy in and demand shoots up, the stock price naturally rises, right? And the manager profits personally. Their professional judgment was corrupted entirely by their own self-interest. So, what's the fix? Well, according to the ethical framework, the solution is total transparency. Correct ethical conduct requires the professional to disclose their ownership clearly. Disclosure is absolutely critical. By laying all their cards on the table, it ensures that the recommendation can actually be judged objectively, and you know exactly what their true motivations are. Okay, imagine an investment advisor comes up to you and guarantees, listen, you will definitely earn a 25% annual return on this investment. Sounds amazing, right? Sign me up. But hold on. From an ethical standpoint, that is a massive, glaring red flag. Why is it a red flag? Because, quite frankly, future returns are completely uncertain. Nobody has a crystal ball. Under the ethical standards of professional conduct, it is a severe violation to misrepresent information. Ethical professionals are strictly forbidden from guaranteeing performance or exaggerating returns or making any sort of false claims. Doing that totally violates the principles of integrity, fair dealing, and basic professionalism.
The ultimate goal: investor protection.
Let's pull back for a second and look at the big picture. Why do these rigorous rules, these ethical frameworks, and these super stringent requirements even exist in the first place? The Code of Ethics is highly respected globally because it provides immense systemic value. It builds investor confidence, it improves market efficiency, and drastically reduces financial fraud. It ensures transparency and fair dealing. And honestly, this is exactly why major institutions, we're talking BlackRock, Goldman Sachs, JP Morgan Chase, have such strict compliance systems and insider trading controls. Reputation and long-term market trust are incredibly valuable in finance. And without ethics, the markets simply become unstable. So, we end with this final, totally provocative thought for you to take away. Is the person managing your money acting as a true fiduciary? Do they actually put your interests above their own? Do they openly disclose their conflicts? Do they adhere strictly to the highest ethical standards and not just scraping by the legal minimums? It's your wealth, and knowing the framework we've explored in this explainer today really empowers you to ask your advisors the tough questions. Thanks so much for joining me, and hey, keep asking the right questions.